Okay, good evening, everyone. Today is Wednesday, the 29th of October, 2025. Today, we'll be talking, which will be part one of our discussion on how we proceed to prepare and present consolidated statement of cash flows, or what some people call group cash flows. Now, we'll first of all be leveraging on the fundamental principles of statement of cash flows for a single entity, okay? And that is strictly from the perspective of IAS 7. And thereafter, we will equally be looking at it in addition to perspective of IAS 7. We will also inculcate some of those things that we've learned with respect to IFRS 10, okay, which border on consolidated financial statements. Now we'll be marrying these two principles alongside other knowledge and applications we've had with respect to incorporating the investments in associates and interest in joint venture into the whole process, okay? Therefore, it's going to be a combination of standards and knowledge that we have, which I could call priority knowledge, to trying to more or less imbibe and use in solving these problems that we might be faced. Which then means that we will more or less be making references to various principles and practices starting from IAS 7 to IFRS 10, and later we'll branch at IAS 28, as the case may be, all of it within the context of allowing us to present consolidated statement of cash flow, which will be the fourth statement that we need to demonstrate in order to present group accounts. Okay, and I think we need to refresh our memory first. And let me switch to my notes. Okay, we need to refresh our memory first to why the statement. Okay, why the statement? Okay, if you could recall, there is a dichotomy between accrual basis and cash basis, okay? And the key delineation between them is that accrual basis recognizes transactions as they occur, and on that premise, transactions are recognized based on the fact that we recognize income when income is earned and not necessarily when income is received. And likewise, we recognize expense when expense is incurred and not necessarily when it is paid. Okay, but when we look at cash basis considered from a separate perspective, and cash basis recognizes transaction only when cash is exchanged or cash is involved. Which then means that accrual basis is responsible primarily for completeness of accounts and equally responsible for us to be able to ascertain the financial performance of an entity at any point in time with respect to profitability, as opposed to cash basis. But cash basis also have its own unique relevance, and most especially in helping us to more or less recognize transactions on the premise of involvement of cash. And therefore, we are able to ascertain not only the amount of cash we have at hand or in the bank, but most especially, it assists us to know the sources and the utilization of cash we have. And this will also guide us much effectively in the process of more or less guaranteeing our liquidity and management of cash effectively. Therefore, it's on this premise that we present 4 statements. Okay, there are 5 components of financial statements, namely the statement of financial position, the statement of financial performance or statement of profit or loss, the statement of changes in equity, the statement of cash flow, and the notes to financial statement. Of all these 5 components, 4 of them represent statements. And of these 4 statements, 3 of them, which is the statement of financial position, statement of profit or loss, and statement of changes in equity, follow strictly the principles of accrual basis. Whilst the last statement, which is the statement of cash flow, follows the cash basis. Okay? Therefore, the next question we now need to center upon is to say, okay, in line with IAS, in line with IAS 7, what are the activities that give rise to cash flows? Now, cash flows from 3 different activities. From operating activity, and operating activity can be considered as your core activity or your primary activity, or I could call it your principal activity. Therefore, any activity that generates cash flow that is critical and principal or core to your operation, therefore, such activity in general will be classified as operating activity. But you can't operate without support system. And you have to invest in your support system. And when I say support system, most of them are much more in terms of item of property, plant, and equipment. And also some items that are intangible in nature. And likewise, also any form of investment you might have in financial assets. All of these are support systems to your operations. And therefore, any cash flow resulting from either acquisition or disposal of this caliber of support system or assets constitute investing activity, which means for every cash involved in your purchase of PPE, your acquisition of intangible assets, or purchased or investment in financial assets, likewise, disposal of same will constitute activities within the investing space. And therefore, such activities and the cash flow will be reported within investing activity. Likewise, prior to operation and prior to investing, we need funds or what I'll call finance, being able to more or less make this investment and equally invest in our operations. Therefore, every activity that borders on how we get finances for an entity in order to execute its projects, be it in working capital, which is the operation, be it investing capital, which is more or less assets to support the operation. Such activities will fall under what we call financing activity. Now, for financing activity, these are activities that more or less give rise to how we source for funds and how we more or less repay those funds to various stakeholders, be it the shareholder or the debt holder, as the case may be. Which then means that anything that borders on raising funds either by equity or debt, or repaying those providers of capital, which is in terms of dividend or interest or repayment of the principal amounts, or even the buyback of shares of companies for cash, all of this constitutes financing activity. Which then means, as I've said earlier, for investing activity, they are looking at things that constitute the support system, such as PPEs and cash flow relating to financial assets. Why financing activity deals with movement in and out of the company in relation to the providers of capital, which could be issues that borders on cash flow arising from debt or equity. And that is just the summary of that. Furthermore, unlike investing activity and financing activity, operating activity can be presented in two different ways. The first way is that we can present it directly, and in the second vein, we can present it what? Indirectly. What is the difference? The difference border on one. For direct activity, we are trying to look at the nature of those transactions or categories of transactions that contribute or are the source or sources of cash into the company, and also those ones that constitute outflow of cash away from the company. And in this instance, we'll be looking at things like receipt of cash from customers. We'll be looking at things that borders on payments to vendors or suppliers. We'll be looking at things that borders on payments to employees, which is payment of salaries. We will be looking at activity within our operations that border on payments for other expenses other than purchases. And last, we'll be looking at payments for income taxes. All of these activities are what constitutes the direct source of cash or utilization of cash. And for short, where you hear present your operating cash flow from operating activity using direct method, that is what they are saying, as opposed to the indirect method. The indirect method is simply trying to create a nexus or a link between profit, how profit can tend towards cash, which means trying to reconcile profit to cash. How can we reconcile profit to cash? And under this premise, you start from the first point of call, which is your profits before taxes. Okay? And my objective is to reconcile this profit to cash. And the first thing I will consider is that there are transactions that impact profits or impact loss, but some of them are non-cash items. Therefore, every transaction that impact profits that are non-cash items, I have to adjust for them. Similarly, there are some items that maybe they have cash implication or they are cash-based, and equally they affected the profit, but they do not qualify as operating activity. Therefore, non-operating activity cash items are equally adjusted for. Thereafter, the impact of movement in working capital as it affects my profit have to be adjusted for, which means I have to adjust for movements in working capital. And when we are adjusting for movement in working capital, we have to keep abreast of this information. The first thing you need to be wary of is that cash and cash equivalent items within your working capital will not be adjusted for. That means they will be excluded. Example are cash and bank balances, bank overdraft, and any short-term marketable instruments that qualify as cash and cash equivalents. Again, you will not also adjust for within these items that primarily constitute a separate adjustment, either as a non-cash item or as a non-operating cash item. Also, you will not adjust for movement in current tax payable or current tax assets, or because within the operating activity, there's a separate section for the presentation of payment of income taxes. And therefore, movement in current tax payable or current tax assets will equally not be adjusted for. And likewise, some other peculiar movements that may not necessarily be considered as an adjustment for operating activity purpose. Thereafter, all things being equal, we can now recognize, similar to direct method, the payment for income taxes, which means the cash paid for our corporate taxes in that year. And that is how we present the statements of cash from operating activity. By And by and large, where we present our statement of cash flows, let me say for 2024, you have the first section, your net cash flow, from operating activity, you identify it. Whatever it is, your net cash flow let us assume is negative, used by investing activity, we adjust for that. And lastly, the net cash flow from financing activity. The sum of these may give us increase or decrease in cash. And in this case, it gave me one that's 110, I guess. Now, invariably, I need to now bring forward my cash and cash what? Equivalent at the beginning of the year, maybe 90. And that gives me my cash and cash equivalents as at the end of the year, which is what? 200. That is a summary of our presentation. Okay? That is in line with ISF for single cash flow. Now, how do we now move away from this to where we are? Now, we will be leveraging on this knowledge to discuss on consolidated statements of cash flows. Now, we are going to be using the exact principle of single is what apply, which means flowing from IAS 7 statement of cash flow for a single entity. What then we do is to adjust for certain items. Okay, and these items are items that are peculiar to group accounts and investment in associates and joint venture. And what are they? One, we need to deal with non-controlling interest. How do we treat NCI within the group account? The second one border on peradventure we have investments in associates and or interest in joint ventures. Therefore, what will be the category of treatments of these within the statement of cash flow at the group level? Third, we need to deal with impacts of acquisition of a new subsidiary in a year. What form of treatment are we going to give to it? And finally, how do we treat the impacts of disposal of a subsidiary in a year? What form of treatment are we going to give to it? These are the things that are on the table for us to do or play with. Okay, as I now switch, if there's any question before we now continue, I'll be glad to hear the question. Okay, if there's none, we can continue their notes. Now, let us now deal with this situation one by one. When it comes to non-controlling interest, what matters to us in non-controlling interest is the impact of cash flow in the movement of non-controlling interest in a year. And the impact, assuming there's no other increase in non-controlling interest or decrease in non-controlling interest associated with changes in the ownership structure of a subsidiary, the only impact that can be ascribed to non-controlling interest is the dividend that the non-controlling interest will have received from the group as a result of dividend that is paid by the subsidiary to the non-controlling interest in a year. And how do we determine that? Let me drop my highlighter here. Now, if you look at this, whether I want to use T account for you or I want to do it vertically, remember, non-controlling interest is an equity within the group, but it is the equity attributable to other shareholders outside the parent. And therefore, all things being equal, equity should have a credit balance. That means if you have no controlling interest, the balance brought forward for non-controlling interest, which is the equity attributable to non-controlling interest, will be on the credit side because equity primarily supposed to be on credit. except if the equity is negative, which means the value has been eroded. Likewise, there's also a possibility that dividend appropriately declared last year may not have been paid fully, in part or in full, by the subsidiary to shareholders. Thereby, the non-controlling interest may equally have a balance of dividend due from the subsidiary. And remember, anything due from subsidiary is likewise due from the group, because the subsidiary is an integral part and member of the group. Therefore, all things being equal, the two balances will be on the credit side. The balance relating to dividend due to the subsidiary at the end of last year, which we brought forward, and balance of the equity attributable to the NCI last year, which is brought forward this year. Now, if during the year the subsidiary makes profits, when we share profits, the implication of that is that it's going to increase the equity value of the non-controlling interest. Therefore, we need to credit that account in order to further increase the equity value of the non-controlling interest. But likewise, what if it's a loss? It's going to be debited, which means used to reduce the equity value of the non-controlling interest. Now, at the end of the year, from our balance sheet, we know what is the balance carried forward for the equity, and also what is the balance carried forward for the dividend payable to non-controlling interest. If dividend has not been paid in a year, you will find out that the sum of the debit, when you add these first three together, plus the sum of the credits, supposed to tally. But when they fail to tally, it shows that for there to be a reduced balance at the end of the year, it means you paid cash to the non-controlling interest. And the year in, year out cash you pay to non-controlling interest is majorly attributed to dividend that you have paid. And that's why, to balance the account, we're able to attribute the difference, which serves as a reduction in the equity value of non-controlling interest, as being the dividend paid to non-controlling interest in that year. This empty account is what we can find beneath, which means for vertical, we only understand the principle that our opening balances is increased by share of profit to the NCI, or decreased by share of what? Loss. And if these four items are aggregated, it's supposed to equal to these last two balances, which are carried forward. But once it's not equal, the movement in it is the balancing figure, which is the dividend paid to the non-controlling what? Interest. Now, let's look at this illustration. I'll copy this illustration. I'll put it on our Excel sheet, and we'll use it to demonstrate our understanding. Okay. I'm switching to my exam. Can somebody read this question? I need somebody to volunteer by show of hand, and I can grant you access. Okay, who will volunteer? Can somebody volunteer? I can't see any answer. Okay, promise. Can you read?
Given the following information from the consolidated financial statement of IVA for the year ended December 31st, 2018-2019, dividend payable NCI declared before year end, NCI share of group net assets, NCI share of group profit for the year. Determine the dividend paid to NCI in the year and disclose how it will be treated in the consolidated statement of cash flow.
Okay. Let me assume this is it, all figure in naira. Now, given this information, I start with my balance brought forward. And there are two balances. The first one is balance based on the share of net assets. Which is the same thing as equity balance of NCI. And the second balance is with respect to dividend payable to NCI. Now, at the beginning of the year, 2017 is the start date. Okay, let me indicate that. You have to be wary which year comes first. Is it 17 or 18? Forget the order. This is the start date, and this is what? The end date. Therefore, my opening balance is 345 for the net assets and 80. And therefore, if that is the case, the sum of my opening balance is 425. Now, during the year, there was a share of profit. And what was relevant is the share of profit in 2018. Remember, the account we are doing is for the current year, which is for 2018 financial year, which is the current year. Now, given so, my share of profit to NCI, which means share of subsidiaries profit to NCI, will increase this by 60. And doing so, it means the equity value plus the dividend payable, when you sum it up, supposed to increase from 425 to 485. But let us compare this 485, which is our expected value. Expected balance carried what? Forward. Let us compare it with the actual balance carried forward in our consolidated statement of financial position. And what are they? They constitute the same item here, meaning that I'll change drop forward to carry forward. What is the balance at the end of the year? At the end of the year, if I could highlight it, it is 390 and 50. Therefore, 390 and 50. When I sum 390 and 50, what I get as my actual balance is 440. The question then is, when I compare 440, what is the difference? And what does that difference tend to be? The difference between my expected and my actual is 485 minus 440. And the only thing that will have reduced the amount from 485 to 440 is what? Is the dividend that has been paid out to non-controlling what? Interest. And that is how we arrive at our position here. Okay, now the question then is, how do we treat the dividend paid to NCI? The first thing is, what activity will it qualify to be? And if your guess is mine, I'll classify that as what activity? Who can tell me the activity? I'll classify it as. Non-controlling interest is said to be equity of other shareholders other than the parents. And equity serves as a source of finance. Therefore, I will classify it as financing what? Activity. Second, as a financing activity, is it an outflow or an inflow of cash? And if your guess is mine, it is nothing other than dividend you pay to people outside the group or paid by the group to anyone is an outflow of cash. Therefore, it means it's going to have negative impacts on our cash position. And as such, we are going to treat it in that manner. Any question on this first one? Remember where we are coming from. We have only now dealt with the first principle that we need to take as an adjustment, which is the treatment of NCI in the consolidated statement of cash flow. Any question, you can send a chat or raise up your hands. Any question on that? Any question? If there's no question, let's go back to our material and look at the second principle we want to discuss. The second principle we want to discuss is on the treatment of our investment in associates or similarly in joint venture. And there are three things possible that we need to consider, either for adjustment for non-cash item or to recognize impact with respect to cash flow item. The first one is in similar vein to dividend paid to NCI. We can equally consider what could reduce our investment in an associate other than loss is the amount of dividend we received from the associates or joint venture when such dividend is declared and paid by the associates. The only difference is that as NCI is equity, which is a credit balance, associate is an asset, which will have a debit what? Balance. We'll look at that. Secondly, we'll look at situations where transaction occurs between the parent or its subsidiary and an associate. Such transactions will include financial transactions that has significant cash implication, most especially loans between the associates and the member of the group. The cash flow implication of that will also have to be recognized and presented in the appropriate section or activity.